What is leverage? Well, leverage can be defined as using financial tools or borrowed money to control larger investments. It uses less capital upfront. So, let's say you're trying to buy a stock, and let's say you have $1,000. And let's say you want to buy stock XYZ. Now, let's say you do 2 times leverage. What 2 times leverage means is that for every percent gain, it becomes 2 times the next percent gain. So for example, let's say I gained $100, or we can say 1%. Not for this number, by the way. This would amplify to $200, or 2%. It basically multiplies the returns of your investment. It also multiplies the loss in your investment. So for example, let's say stock XYZ is trading at $100. Okay? Let's say you bought this stock XYZ. Let's say you have 10 shares. Okay, so 10 shares times $100. Right? So, let's say XYZ becomes $110. Without leverage, so this is without leverage. Without leverage, your investment becomes from $1,000 initial. This is initial. This investment becomes $1,100 because the stock went up 10%. Now, let's say you have leverage on stock XYZ. If XYZ was 100, you're going to spend $1,000, but you're going to use 2x leverage. You're going to pay $1,000, but then you get to control $2,000 worth of the stock. So your shares multiplies by 2. Even though you don't own $2,000, you are controlling this amount of capital. So I'll explain it. Let's say XYZ goes to 110. Your return is not just $100 like in this example. Your return becomes $200 because your stock went from $2,000 to $2,200 because of this 10% up. So effectively, from your return on investment, from your original capital, which was $1,000, you gained $2,200 minus $2,000, which was $200, and this is 20% of this. So you effectively gained 20% return. Now, this might seem great and all, and it has a lot of applications. Not only for stock trading, you can also use it for real estate. You can also use it for forex trading, for currencies. And you can also use it for derivatives. You can also use a type of derivative which is options, but using leverage with options, it's a little risky, so I wouldn't recommend this, but it's an option, of course. So a benefit of leverage. So leverage amplifies returns, but it also amplifies the downside. So you might see, if you check your stock brokerage, you might see leverage stocks. You might see leverage stocks. Leverage stocks are different than just borrowing money, because if you have a margin account on a stock brokerage, if you have a margin account, margin accounts, they borrow money from the broker, okay? While leverage stocks, it uses swaps and derivatives to achieve this sort of leverage. The actual stock is going up twice the amount of the original stock that it's tracking. So examples for leverage stocks, you have TQQQ. TQQQ is basically a leveraged QQQ tracker. Let's say the leverage on TQQQ is 3 times. So the leverage on TQQQ is 3 times. So if you put in $1,000, if the stock goes up if the original QQQ goes up 10%, your TQQQ would go up 30%. And this is on a day basis. This is important. This is on a day basis. I'll show you why later this is important. For margin accounts, the exact same thing would happen. Let's say you poured 3 times your original capital into QQQ. You're not going to use this leverage product. You're just going to borrow money from the broker. The brokers charge between 5 to 12% interest rates on these borrowed capitals. That's the industry standard. But that is one of the factors you also need to consider into. So, if you have 3 times original QQQ and you have 3 times original capital, if you ignore the interest rates that you have to pay over time, then your return from 10% would become 30%, because it's a 3 times thing. But here's the difference. Leveraged ETFs, they reset per day. I'll show you why this is really important. Because let's say the original asset, QQQ, let's say QQQ is at 100, okay? $100 per share. Now, let's say QQQ goes up 1%. Let's make it easier. Let's say 10%. It becomes $110 per share. Okay, let's say one day it goes up 10%. Let's say the next day it goes down 10%. Then it goes from $110 to $99. So overall, this entire thing has a decrease of minus 1%, this return from these 2 days. 2 days. The 2 days of QQQ has a minus 1% return. Now, let's say we do this, but for TQQQ. TQQQ. So, if QQQ goes up 10% in 1 day, then TQQQ, let's assume it starts at $100 as well. It goes to $130 because it's a 30% return. It's tracking this. It's tracking the QQQ, so it will 3x returns of QQQ. 3x returns of QQQ. Now, let's say the next day, TQQQ goes from $130 and it goes down 10%, exactly like this. Since it's tracking the leverage day by day, that's the key term. It's tracking it day by day. So it will drop 30%. Down 30% would become $91. And overall, this return is a minus 9% return. We're investing in the same product, but it's giving us 2 vastly different returns. This is why it is risky to use leverage ETFs. Over the long run, a choppy market with up and down like this, each sort of fluctuation in the stock is going to eat away using a compound effect at your original capital. With this exact scenario, since QQQ only dropped 1% over this up 10%, down 10% type movement, and then when we go to TQQQ, it still uses the same type of movement, but it makes our returns less, up to negative 9%. Leverage ETFs are good in a market that has a direction. Your leverage is better because if you have 30% returns on one day and then you add another 30%, it's not just going to become 60% returns. It's going to have a compounding effect. As you can see, we can try an example. Let's say it goes to 100, then 30%, it goes to 130, then another 30%. Let's say the original QQQ was just doing 10% for one day, then another 10% the other day. The reason why leverage ETFs are good here is because, look, your capital becomes 169. It is a 69% return. 69% return. While QQQ would have a 100 to 110 to 121. So this would have a 21% return. Now keep in mind, if you were using your broker's account, your return in this scenario, if you invested in QQQ, your 21% return, borrowing your broker's money, would become 63% return if you use a 3x leverage from broker. Right? But if you used a leveraged ETF, your returns would become 69%. Now, this is the key. The returns are higher in a direction market. The returns are lower in a choppy and volatile market. Now, there are many risks of using leverage. The risk number one, you could lose your entire capital. Your entire capital could be wiped out if you use high leverage. In our examples, we used only 3x leverage. In crypto markets, or cryptocurrency and Forex, in crypto and Forex, they give up to 100x leverage. This means that 1% change in the asset leads to your account being liquidated. Liquidated means when your assets have to be sold to cover or prevent debt, because you are borrowing the broker's money. You're borrowing the broker's money. The second risk, if you use your broker's margin, the interest rates are very high. As of recording, the US interest rates are at 4.5%. Now, brokers have to make profit, so they will charge you higher than the interest rate to borrow the money so that they can make the spread. Let's say one of your brokers charges you 6% interest. They make the 1.5% spread. They make the 1.5% spread. This is why it is risky, because over time your asset could be like stable. It could not move. But since you are borrowing money and you have to pay the broker the interest, your actual stock or your actual returns might look something like this. It might be decaying. This is decaying. These are some of the risks for leverage, but there are a lot of upsides as well. Like, you can make a lot more money on little capital. And it can amplify returns for those that have small accounts. And that's basically it for leverage. Hopefully you learned something today. And see you next time.